Loss control equals mental clarity. How managing downside risk reduces psychological stress. Investors often think risk management is about protecting money. But equally important, loss control protects mental stability. A controlled downside does not only defend capital, it preserves clarity, discipline, and emotional balance. 1. Uncertainty is more stressful than loss. Behavioral research by Daniel Kahneman shows that humans are highly sensitive to potential loss. However, psychological stress increases most when outcomes are uncertain. An unmanaged losing position creates continuous doubt, rumination. Should I sell? Anxiety, constant price checking. A predefined loss limit removes uncertainty. Once risk is capped, the mind relaxes. 2. Cognitive load and decision fatigue. Open-ended risk consumes mental bandwidth. Investors without clear risk parameters often monitor prices obsessively, second-guess themselves, react emotionally to volatility. This increases cognitive load and decision fatigue. By contrast, structured loss control reduces monitoring, eliminates improvisation, preserves mental energy. Less mental noise leads to better long-term decisions. 3. Small losses prevent emotional escalation. When losses grow unchecked, emotional intensity rises. Unchecked drawdowns trigger panic, denial, averaging down impulsively, strategy abandonment. Controlled losses remain psychologically manageable. They prevent escalation from discomfort to distress. 4. Predictability creates calm. Markets are inherently unpredictable, but risk management introduces predictability into personal exposure. You cannot control market direction, news, macro shocks. You can control position size, maximum loss per trade, portfolio allocation. Control reduces anxiety. Anxiety reduction improves consistency. 5. Professional discipline and stability. Investors, like Warren Buffett, have long emphasized avoiding permanent capital impairment at Berkshire Hathaway. While methods vary, the principle remains. Stability enables rational decision-making. A portfolio that avoids catastrophic drawdowns allows the investor to think clearly during volatility. 6. Emotional capital is finite. Financial capital is measurable. Emotional capital is limited, but rarely acknowledged. Large losses deplete confidence, patience, discipline. Loss control protects not just money, but emotional reserves. Preserved emotional capital supports long-term consistency. 7. Strategic calm improves performance. When investors feel secure, they follow rules. They avoid revenge trading. They stay aligned with long-term strategy. Mental comfort is not weakness. It is operational strength. Clarity leads to better risk assessment. Better risk assessment leads to better compounding. The core insight: loss control is not pessimism. It is structural calm. By defining risk in advance, you remove the most destructive element in investing: uncertainty about your own exposure. When downside is controlled, the mind becomes quiet, and a quiet mind makes better decisions.